We are witnessing a pivotal moment in financial markets that has profound implications for investors worldwide. Gold has just shattered a critical psychological and technical level that many analysts have been watching for months. As of mid-February 2026, spot gold is trading around $5,000 per troy ounce, a milestone that seemed impossible just a few years ago. This breakthrough represents far more than a simple price increase. It signals a structural shift in how markets are functioning, how central banks are positioning themselves, and what investors should expect in the months and years ahead. Understanding this moment requires us to move beyond surface-level enthusiasm and examine the deep underlying forces that are reshaping the precious metals market. The journey to this level has been remarkable. Gold rose 55% throughout 2025, breaking through $3,000 per ounce in May, $4,000 in October, and finally establishing itself above $5,000 in late January 2026. On January 29th, the metal reached an intraday high of $5,995, representing a surge of nearly $1,300 in just the first month of the year. This was not a gradual climb, but rather a compressed rally driven by multiple converging factors that have fundamentally altered investor behavior and market structure. The drivers of this rally are not random. They reflect genuine economic and geopolitical conditions that are unlikely to reverse quickly. First, we must discuss the geopolitical dimension. Global tensions have escalated significantly in early 2026. The capture of Venezuelan President Nicolas Maduro, combined with escalating rhetoric from the United States regarding the Iranian regime, created a sudden spike in safe haven demand. Whenever investors perceive heightened international risk, they inevitably move toward assets that hold value outside the traditional financial system. Gold has always served this role because it cannot be devalued by government policy, cannot be frozen in sanctions, and maintains purchasing power across borders and currencies. This safe haven premium that has now embedded itself in gold pricing is sticky, meaning it does not evaporate quickly when headlines fade. Second, we must examine the economic fundamentals driving the rally. Despite moderation in inflation rates across developed economies, governments continue to run significant deficits and accumulate debt at unsustainable rates. The United States federal debt exceeds $33 trillion, while other major economies face similar or proportionally worse fiscal challenges. The concern among institutional investors is not that inflation will return to the highs of 2022 and 2023, but rather that governments lack credible pathways to address this debt without either implementing austerity measures that slow economic growth or allowing a slow erosion of currency purchasing power through monetary inflation. Gold protects investors against both scenarios. In a growth slowdown, it serves as a safe harbor. In an inflationary scenario, it maintains real wealth. This dual utility is driving a fundamental reallocation toward precious metals among sophisticated investors. Third, currency dynamics are playing a supporting role in gold appreciation. The US dollar has weakened relative to historical trends, despite being strong in absolute terms compared to other major currencies. The Federal Reserve has shifted toward a more accommodative stance, with market participants interpreting forward guidance as suggesting that rate cuts may continue even as inflation remains above historical averages. A weaker dollar mechanically supports gold prices because gold is priced in dollars on global markets. When dollars weaken, gold becomes cheaper for foreign investors, which increases demand, and conversely makes dollar-based investors more willing to hold gold because it appreciates relative to their currency base. This currency dynamic reinforces the basic safe haven story. Fourth, and perhaps most important for long-term investors, central bank demand has surged. According to the World Gold Council, central banks purchased approximately 800 tons of gold in 2025, representing roughly 26% of annual mine output. This is not typical buying behavior. In historical context, central banks purchased around 400 tons annually in the 2 decades before 2010. The shift began in 2022 and has accelerated, with emerging market central banks leading the charge. Countries including China, India, and various BRICS members have dramatically increased gold reserves as part of a broader de-dollarization strategy. They are positioning gold as an alternative to holding exclusively dollar reserves, which reduces dependency on U.S. monetary policy and sanctions risk. J.P. Morgan research forecasts that central bank and investor demand for gold will average 585 tons per quarter throughout 2026. This is not speculative buying. This is institutional positioning that reflects real, long-term concerns about monetary systems and currency stability. Fifth, investment demand through exchange-traded funds has exploded. United States gold demand more than doubled to 679 tons in 2025, driven almost entirely by physically backed gold ETFs. These investment vehicles have democratized gold ownership, allowing retail and institutional investors to gain exposure without dealing with storage, insurance, and authentication challenges associated with physical bullion. As more investors have accumulated gold through ETFs, and as prices have continued to rise, momentum has built. This dynamic is self-reinforcing, but also means that certain types of flows could reverse quickly if sentiment shifts. Understanding these drivers is essential because they tell us that while volatility from this elevated price level is inevitable, the fundamental case for gold remains intact. However, recent trading action requires attention. Gold experienced a significant pullback in early February, declining roughly 21% from its January 29th highs of $5,995 down to around $4,900. This is not unusual after a move of this magnitude. Professional investors and traders use pullbacks and corrections as natural parts of market dynamics, and analysis suggests this decline is a positioning reset and volatility adjustment rather than a collapse in the bull market thesis. For investors considering exposure at these levels, several implementation strategies deserve careful consideration. The choice between different vehicles for gold investment has meaningful implications for returns, tax efficiency, and practical convenience. Physical gold, including coins and bars, offers direct ownership and psychological appeal. Many investors find comfort in owning tangible assets they can hold or store. However, physical gold comes with documented costs. Dealers typically charge premiums ranging from 2 to 5% above spot price when you purchase, and you may face spreads of similar magnitude when selling. Storage and insurance costs add another 0.5 to 1% annually for professional vault services. If you store gold at home, you assume security and insurance risks that can be substantial. From a tax perspective in the United States, physical gold held longer than 1 year is subject to long-term capital gains taxation at a maximum rate of 28%, which is higher than the preferential 15 to 20% rates applied to stocks and equity investments. In Canada, 50% of capital gains are included in taxable income, effectively meaning a 50% reduction in the taxable gain. In the United Kingdom, legally tender coins are exempt from capital gains tax, while foreign coins and all bars are subject to capital gains taxation. In Europe, tax treatment varies by country, with some nations treating gold favorably and others imposing VAT or higher capital gains rates. Understanding your local tax regime is essential before committing capital. Gold ETFs represent the opposite approach. These investment vehicles track the price of gold, typically by holding physical gold in allocated vaults managed by custodians. The advantages are substantial. Liquidity is excellent, with ETFs trading continuously during market hours at prices reflecting real-time gold spot prices with minimal premiums. Management fees are typically lower than the costs associated with physical ownership and storage, usually ranging from 0.2 to 0.4% annually. From a tax perspective in the United States, gold ETFs are treated as collectibles and face the same 28% maximum capital gains rate as physical gold, so there is no tax advantage. However, the ease of trading within a brokerage account and the elimination of storage concerns make ETFs practical for most investors. For Canadian investors, the same 50% inclusion rate applies, and for international investors, the tax treatment usually aligns with the jurisdiction where the ETF is domiciled rather than where the investor lives. ETFs are ideal for investors who prefer convenience, are concerned about counterfeiting of coins or bars, or simply want rapid liquidity without the friction of selling physical precious metals. Beyond coins, bars, and ETFs, other vehicles exist. Gold mining stocks provide leveraged exposure because mining companies benefit from rising gold prices while also having operational leverage. If gold rises 50%, a well-run mining company might see earnings rise 100% or more. However, this leverage cuts both ways. Mining stocks also have operational risks, reserve replacement challenges, and geopolitical exposure. Gold futures and options provide additional trading vehicles, but are primarily suited to sophisticated investors with meaningful experience in derivatives markets. For the purposes of this discussion, physical gold, ETFs, and mining stocks represent the primary choices for most investors. A prudent allocation framework typically involves recognizing gold's role as a portfolio stabilizer rather than a growth engine. Academic research, including analysis from J.P. Morgan and State Street Global Advisors, demonstrates that a 5% gold allocation reduces overall portfolio risk by approximately 5%, while contributing only 1.9% to total portfolio risk. This occurs because gold has consistently shown negative or near zero correlation with stocks and bonds, meaning it moves independently and often in opposite directions during market stress. The tactical question becomes not whether to own gold, but how much to own and which implementation vehicle aligns with your circumstances and time horizon. For conservative investors seeking stability, a 3 to 7% allocation to gold ETFs or physical coins held in allocated vaults makes sense. For income-focused investors or those in early retirement, the allocation might be lower since you need your portfolio generating income and capital appreciation. For younger accumulation phase investors, an even lower allocation of 1 to 3% can provide insurance without meaningfully drag on growth. The allocation should be rebalanced periodically. If gold rallies significantly, as it has in early 2026, you might find your gold position has grown to represent 12 to 15% of your portfolio. Disciplined rebalancing requires you to take profits by selling some gold and redeploying those proceeds into other assets. This is psychologically difficult when prices are rising rapidly, but it is the mechanism by which systematic investors capture gains and reduce concentrated risk. Risk management deserves explicit attention. The gold market is not infinitely deep. When gold reached $5,995 per ounce on January 29th, it had risen nearly $1,300 in a single month. This kind of rapid appreciation inevitably attracts speculative attention. Speculators use leverage, meaning they borrow money to magnify their exposure to gold price moves. As speculation increased, market participants borrowing money to finance positions became increasingly vulnerable to a price reversal. The February pullback occurred when market conditions shifted and leveraged positions were liquidated, creating a cascade of selling that compounded the price decline. This is a normal aspect of commodity market functioning, but underscores an important principle. Do not deploy leveraged or borrowed money into gold positions, regardless of how bullish you feel about prices. The psychological temptation to amplify your returns through leverage is powerful, but the mathematical reality is that leverage amplifies losses with equal or greater force. Conservative position sizing and a commitment to buy and hold with periodic rebalancing will deliver better risk-adjusted returns than attempting to time prices or use leverage. The question of future price movements requires honest assessment. Professional forecasts for gold by late 2026 range from reasonable to aggressive. Goldman Sachs revised its year-end 2026 forecast upward to $5,400 per ounce. JP Morgan sees prices pushing toward $5,000 by the fourth quarter of 2026, with $6,000 per ounce possible longer term. ANZ recently forecasted $5,800 per ounce in the second quarter of 2026. These are not consensus forecasts, but rather reflects analyst expectations spanning a range from conservative to bullish. A careful reading of market conditions and analyst commentary suggests that consolidation is likely in the near term. Gold is likely to range between $4,800 and $5,200 per ounce for the next several weeks as traders and investors digest the recent volatility and reassess positioning. The intermediate-term outlook, spanning the next 6 to 12 months, remains supportive given the structural demand factors we have discussed. The convergence of geopolitical uncertainty, central bank buying, ETF demand from retail investors, and continued fiscal concerns across developed economies creates a durable bid underneath the market. However, this does not mean gold will rise in a straight line. Corrections of 10 to 15% are normal and should be viewed as buying opportunities rather than signs that the bull market is ending. The long-term outlook through 2027 and beyond is shaped by scenarios that extend beyond the scope of what any forecaster can predict with precision. If global economic growth accelerates and central banks normalize interest rates upward while geopolitical tensions ease, gold would likely consolidate or decline moderately from current levels. The metal would still maintain high value as a portfolio diversifier, but the speculative premium and urgency driving current demand would fade. If, conversely, global growth stalls, interest rate cuts accelerate, or geopolitical tensions escalate further, gold could exceed $6,000 per ounce, with some bulls suggesting $7,000 or higher becomes achievable. The prudent approach for investors is to acknowledge this uncertainty explicitly and position accordingly by maintaining a measured allocation rather than betting heavily on any single scenario. Tax planning deserves more detailed attention given the substantial profits many investors have accumulated. In the United States, if you purchased gold at $2,200 per ounce and it is now trading at $5,000, your gain is approximately 127%. If you sell now after holding longer than 1 year, you will owe capital gains tax at a maximum rate of 28%. This means you will retain approximately 91% of your gain while the government captures 9%. For a 100-ounce position purchased at $220,000 that you sell at $500,000, the tax bill would be approximately $78,000 on a $280,000 gain. This is significant money, and makes tax loss harvesting strategies potentially valuable. If you have other investments showing losses, you can offset some of your gold gains against those losses, reducing your tax liability. Additionally, consider timing. If you are near the end of a calendar year, you might accelerate sales into that year to secure the advantage of the current tax regime, or you might defer sales into the following year to spread your gains across 2 tax years and potentially benefit from year-over-year income variations. Consult with a tax professional in your jurisdiction, because these strategies have specific rules and limitations. In Canada, the 50% capital gains inclusion is advantageous compared to the United States. A gain of $280,000 becomes $140,000 for tax purposes, meaning you only pay tax on half your actual gain. For someone in the highest marginal tax bracket of approximately 53%, the effective tax rate on your gold gains would be approximately 26.5%, which is lower than the 28% in the United States. In the United Kingdom, the capital gains tax allowance of £3,000 remains unchanged in 2026, and gains above this threshold are taxed at 20% for most investors and 20% for higher earners. Legal tender coins minted by a European country are exempt from capital gains tax, which explains why some UK investors prefer British sovereigns or other legal tender bullion coins. European investors face jurisdiction-specific rules that vary significantly. French investors pay capital gains tax on precious metals at either 26 and 0.6% or potentially lower rates depending on circumstances. German investors have more favorable treatment if gold is held as part of a long-term investment strategy. The complexity of international taxation means that investors living or working across multiple countries should definitely consult professional tax advisors before large transactions. A final implementation consideration involves storage and custody. For investors choosing physical gold, the choice between home storage and professional vault storage has meaningful implications. Home storage gives you complete control and eliminates monthly storage fees, but it creates security concerns and insurance complexities. Professional vault storage, provided by allocated custodians such as established bullion dealers, bank vaults, or specialized precious metals. Storage facilities cost between 0.5 and 1% of value annually, but provides professional-grade security, insurance, and the ability to store gold in geographic locations that provide additional diversification. Some investors split their holdings, maintaining a portion at home for psychological comfort and emergency access, while storing the majority in professional vaults. This hybrid approach balances practical concerns with psychological needs. For forward-looking investors, the strategic question now becomes whether this level of gold pricing represents value or has stretched beyond reasonable fundamentals. The answer requires examining supply and demand dynamics in detail. Global gold mine production has remained relatively flat at approximately 3,000 tons annually, because finding and developing new gold mines has become increasingly difficult and capital-intensive. Most easily accessible deposits were mined decades ago. Developing new mines requires 10 to 15 years from discovery to first production and involves substantial environmental and regulatory challenges. This inelastic supply means that price increases must come from demand shifts, and we are observing precisely such shifts with central bank buying at historic levels and retail investor interest through ETFs at record highs. Against this supply constraint, demand shows structural support from multiple sources. Central banks, as discussed, are purchasing at rates representing 26% of annual supply. Investment demand through ETFs is capturing retail capital flows seeking safety. Jewelry demand, though cyclical and sensitive to economic conditions, still represents approximately 50% of annual gold demand globally. Industrial demand from electronics, dentistry, and other applications remains stable. When you aggregate these demand sources, you can see that the market is absorbing supply and then some, which is mechanically supportive of prices. The historical context is instructive. Gold traded below $300 per ounce in 2001, then rose steadily through 2008, despite the financial crisis. By 2011, it reached the previous all-time high of $1,890 per ounce. It then corrected substantially, spending the next decade under $1,300 as investors believed the inflation threat had passed and as central banks maintained supportive monetary policy that reduced safe haven demand. The recent rally from $1,500 in 2020 to $5,000 today represents a mirror image of the 2011 to 2015 bear market. The move is large in absolute terms, but reflects shifts in how investors perceive currency stability, geopolitical risk, and long-term inflation concerns. It is not unprecedented in magnitude. Looking ahead to 2026 and beyond, several possible outcomes deserve consideration. The bull case argues that gold is not yet in a bubble because the factors driving demand remain unresolved. Geopolitical tensions could intensify. Central banks could increase buying further. Fiscal deficits could expand. In this scenario, gold could reach $6,000, $7,000, or potentially $8,000 per ounce by 2027. The bear case acknowledges current demand, but argues that leverage has compressed the move and that speculative positioning has become excessive. If leverage unwinds more aggressively, or if geopolitical tensions ease, gold could decline 15 to 30%, testing levels in the $4,200 to $4,500 range. The base case recognizes both possibilities and expects consolidation at higher levels, with gold establishing a new equilibrium in the $4,800 to $5,200 range that reflects the genuine structural demand shifts while shedding the speculative premium that drove the rapid January rally. Regardless of which scenario unfolds, the fundamental point for investors to internalize is that gold's role in a diversified portfolio has shifted. It is no longer simply an inflation hedge or a hedge against equity market crises. It has become a currency hedge and a geopolitical risk hedge. This expanded role justifies meaningful allocations across investor types, though the appropriate size of allocation varies based on individual circumstances. A retired investor drawing income from a portfolio should maintain 4 to 6% in gold to buffer against currency weakness and market disruption. A working age investor with a long time horizon could maintain 2 to 4%, relying on other growth assets but benefiting from the portfolio stabilization that gold provides. A conservative investor could be comfortable with 6 to 8% in gold as a replacement for some bond holdings, particularly given that interest rates no longer compensate investors for the risks they bear in traditional bonds. The recent surge and pullback in gold prices has created an opportunity for disciplined investors to add to positions at prices that are elevated by recent standards but remain supported by fundamental demand. Rather than deploying capital all at once, a dollar-cost averaging approach over 2 to 3 months allows you to capture some of the inevitable volatility while gradually building your target allocation. This method removes the pressure of trying to time the market perfectly and instead focuses on consistency and discipline. As you implement your gold investment strategy, remember that this is a long-term positioning decision, not a trading opportunity. The investors who will benefit most from gold at current levels will be those who acquire positions with a 3 to 5 year time horizon and maintain them through volatility, rather than those attempting to capture daily or weekly price moves. The structural drivers are durable. The allocation sizing makes sense across investor types. The tax implications are manageable with proper planning. The implementation vehicles are transparent and accessible. What remains is the psychological discipline to act counter-cyclically, to add when sentiment is negative, and to maintain your conviction during inevitable pullbacks and corrections. This is how successful investors approach precious metals and how they ultimately capture the wealth preservation and portfolio insurance benefits that gold uniquely provides in an uncertain world.